Good morning and welcome to the latest Employment Matters webinar brought to you by the RSM People Advisory Services team. This event and most everything else has changed shape quite a bit over the last 6 months, maybe even over the last 6 days with some of the goings on that we'll touch upon today. I can see a few names today who were regular attendees of the London-based event, as well as many of you now joining from around the country. The use of technology to reach so many of you is great, and of course we'll make sure we continue to do so, but both remotely and in person around the country as the next iteration of normal takes shape. We're very pleased to have a large number of you on this webinar. To minimise any disruption, please ensure that your mic is muted and your camera is off so that we can give all attendees the best experience today. I'm Steve Sweetlove and shall be your host today, firstly introducing our speakers and taking you through the agenda. I'll then put as many of your questions as I can to the panel. Finally, I'll provide a reminder of how RSM are helping our clients in this challenging area and of the support our People Advisory Services teams can give you. If you do have any questions that our panelists can help you with, as with our other webinars, please do use the Q&A functionality to pose these. As I say, I'll ask as many as time will allow, and there's a screenshot there on screen at the moment of just where you're looking there. So look specifically for the Q&A rather than the chat function. Moving to our speakers, I'm joined today by my colleagues Lee Knight, Carolyn Brown and Joe Webber. Lee is an Employment Taxes Director and specialises in helping employers mitigate and manage people-related costs and risks from a taxes point of view. Carolyn is an employment legal partner and is a specialist employment relationships solicitor who heads up our employment legal team at RSM. Joe, an employment taxes partner specialising in the international aspects of people from a compliance, risk and strategic planning perspective. Moving to our agenda, we've got 4 main topics today, each lasting for around 10 minutes. Carolyn will take us through the government support schemes. Joe will cover international remote working. We'll then see a legal update including holiday pay from Carolyn. Lee will take us through the latest on IR35. I'll give us a very brief update on payroll update before getting on to as many questions as we can. So without further ado, I'll pass you straight over to Carolyn.
Thanks, Steve. First then, the job retention scheme. 10 days to go to claim under this, and at the end of the presentation we've got details of our 9 previous recordings on the job retention scheme and on making workforce changes whilst using it. The most recent was on the 12th of October, which we co-hosted with HMRC. So they all have lots of information, and there's more details on our website with long briefing notes. So let's just talk, therefore, in relation to the job retention scheme about the current headlines. We know HMRC has said that they have paid out £39 billion. That's to 9.6 million employments, helping 1.2 million employers. We also know employers have had to adapt their processes significantly to meet the scheme requirements. And HMRC has said they expect an error and fraud rate could be between 5 and 10% of the claims. Overall, HMRC expects employers to check their claims and repay any excess amount. They've already written to 27,000 employers inviting them to correct them. They're following up on 10,000 whistleblowing reports. I suspect quite a large number will be about working on furlough. And their assurance to us is that no one who's tried to do the right thing but made an honest mistake has any need to be concerned, but they add as long as they put it right. So this means checks and notifications of corrections are required, and more shortly on how to do this. So what are the sanctions for getting claims wrong? If you've overclaimed a grant and you haven't repaid it, you should notify HMRC within the notification period, and that period ends on the latest of 90 days after you receive the grant you're not entitled to, 90 days after the day circumstances changed so that you were no longer entitled to keep the grant, or yesterday, 20 October, and that's going to be in relation to grant payment received by the 22nd of July. In relation to penalties, if you fail to notify HMRC that you're chargeable to income tax on an overclaimed grant and you know that you weren't entitled to the grant, then the failure can be considered to be deliberate and concealed, and it could mean a penalty of up to 100% could be charged. So let's turn now, how do you go about checking your claims are correct and that you've paid your employees correctly? I'm just going to give the headlines of these topics here because there's a lot of content, but if I could direct you to one of our previous recordings, you will find this gone through in even more detail in those. So the ranges of review, you first look in the top left-hand corner at whether your employees are eligible and whether the terms you agreed with them fit the job retention scheme requirements. And I've given a range of review there to look at of 9 different areas. And then you look at how you worked out the reference pay. So that's reference pay for everyone furloughed, and how you worked out the hours inputs, and that's going to be for those who were flexi furloughed. And we've directed you there to look at the areas to look at for reference pay and the areas to consider for flexi furlough. And then you need to consider how you did the calculations. And this is an area where we are seeing quite a lot of mistakes, particularly in relation either to claim periods, to calculation of national insurance, or to calculation of pension. And once you've done all that, you need to check that you actually paid the employees correctly. And we've indicated some areas to look at in relation to that as well. I just wanted to mention why we are suggesting that you need to check that you've paid employees correctly, because there are 2 reasons. The first is that the job retention scheme requires all grant claimed to be paid over correctly. So that claimed for pay to be paid over to the employees, the national insurance to be paid to the tax authorities, and pension to be paid appropriately. And the second reason to make sure that the pay is made is the risk of unlawful deduction from wages claims from the staff, except it's not specifically a job retention scheme risk, but that's why you need to make sure that your pay is aligned to the terms that you have agreed with the staff. So what do you do if you think you have overclaimed? In these circumstances, if you've made an error, the error may be in what the agreement terms are, or your calculations are wrong. What do you do? If you've overclaimed, you can either correct it in your next claim, or you can make a payment to HMRC as soon as possible if you're not making another claim. If you're making that payment, you will need a specific payment reference number that begins with an X, and you must contact HMRC to get your payment reference number. In fact, for errors that you spot quickly, you have for some while been able to correct claims 72 hours after you've started them. In terms of not incurring a penalty, the position with HMRC is that they have said they won't charge you a penalty if you didn't know that you'd been overpaid the grant at the time you received it, or at the time the circumstances changed, meaning you stopped being entitled to it, and you've repaid it within the relevant time period. If you're a sole trader or a partner, the relevant time period ends on 31 January 2022. If you're a company, the relevant time period ends 12 months from the end of your accounting period. But I do stress that the notification requirement is part of this repayment process. I'd like to turn now to what you do if HMRC write to you. So if we can go forward to looking at what you do if HMRC write to you. Here on the slide, you will see an example of a letter that has been sent out from HMRC. Clearly the date's now passed, but just to flag, it doesn't indicate why you may have made a mistake, but it does indicate the need to contact both if you have spotted what your mistake is and even if you think that you haven't made a mistake. So just to give you the headlines there. So let's turn now to the new National Workforce Support Schemes of the Job Support Scheme and the Job Retention Bonus. If we turn first to the Job Retention Bonus, I'm covering this first because we now have both the full scheme details and the legislation on it. We got those on the 2nd of October. This is a scheme that is very much connected to the job retention scheme. If you like, it's a run-off benefit under the job retention scheme. So again, starting in the top left-hand corner, like the job retention scheme, this is one for all employers, and it's payable in respect of employees who were furloughed and legitimately claimed for, who are still retained in employment on 31 January and not on notice of termination before the 1st of February next year. So there's 2 points here I wanted to flag. The first one is the requirement for the job retention scheme claims to be legitimate. We understand that if you have claims issues unresolved, it could delay the payment of the job retention bonus. And the second point was the requirement that staff, in respect of whom a claim is made for the bonus, should not be on notice before the 1st of February. We now know that is notice either given by the employer or given by the employee. There are specific criteria in relation to the pay, the average pay that staff for whom claims are made should receive between November this year and January next. That's an average of $520 per month taxable pay as a minimum income threshold. Unfortunately, employees who are transferred under 2P, where the new employer has not made a claim under job retention scheme, will not be able to be claimed for, but periods of family-related or sick leave are not going to lead to a reduction in the minimum amount income threshold. You do the calculation and you get £1,000 bonus per furloughed employee. We know it's payable after February, and you can claim between the 15th of February and the 31st of March. So let's turn now to the job support scheme. I do want to stress that this scheme has not yet been published. We also don't have the legislation, so this is what we know so far from the announcements on the 24th of September. This scheme is not connected specifically to the job retention scheme, although it's clearly intended to be a new form of workforce cost support. Again, in the top left-hand corner, as to which employees and organisations are eligible, there's a different timing threshold in relation to employees, so it's those on an RTI before the 23rd of September. It's not restricted to employers who've used the job retention scheme. However, you can't use this scheme if you've given notice of redundancy to an employee in respect of whom you're claiming. And whilst the entry-level requirements for SMEs are fairly light touch, for larger corporates it's much more restricted than the job retention scheme, because these will have to show that their business has been adversely affected via a financial assessment test, and there'll be prohibitions on payment of dividends and other capital distributions during the scheme. In terms of the employees meeting the criteria and how that works, an employee must work a minimum of 1/3 of usual hours, and the employer must pay for those hours at the normal contracted rate. You need a short-time working agreement with the employees, which I'll go over in a moment. And employees who might have been previously furloughed on reduced pay actually have their underlying usual pay used for calculation of hours, not the reduced pay. You do the calculation for every hour not worked, and the employer and the government each pay 1/3 of the employee's usual pay for those hours not worked, but there is a government contribution cap at $697.92 a month. The grant, the job support grant, will not cover Class 1 employer national insurance contributions or pension contributions. They remain payable. And this new scheme will run from 1st November to 30 April, but claims can be made from December. So the employer will be reimbursed in arrears monthly for the government contribution after the employee's been paid and there has been an RTI notification. So let's turn now to how the claim values work. We hope to be, this is an indication of a government table. So as I said, we don't have the full details of the scheme. If you look at the left-hand column there, if an employee works the minimum of 33% of their hours, the employer cost at the bottom line is 55%, and the employee earnings in the middle, 78% of normal wages. And you can see how it changes where the values for the hours worked are higher. In terms of whether employers can top up wages of employees under the job support scheme, as they could under the coronavirus job retention scheme, all we know is this: the government fact sheet says our expectation is that employers cannot top up their employees' wages above the 2/3 contribution to hours not worked at their own expense. So is that a prohibition on topping up, or is that a statement of likely affordability? We'll have to wait and see. But if we turn now to one of the other areas that are not entirely clear at the moment, and that is the definition of large corporates. We've had a lot of questions here, both about this definition and what the financial assessment test is that they need to meet to access the scheme. I just wanted to flag that usually in relation to definition of a large corporate, we're looking at one or two or more of these metrics: 36 million turnover, 250 employees, or a balance sheet total of 18 million. We will need to see. So if we turn now to what it is that you need to do in order to achieve access to the scheme, and this is in relation to your short-time working agreement. Here you need a legal terms change, so you need to first check whether this is actually a change of contract. Have you got clauses in your contract which will help you? Have you got flexibility? If you don't and you need to get agreement, then you will either have to operate your collective agreement to get consent or obtain individual consent. I don't think that the option of dismissal and re-engage will help here because of the obligation not to make staff redundant, because clearly if you use that you would be. The changes that you need to cover will be the areas that I've shown on that third column there: the pay and benefits, when it starts, when it ends, the working hours and days, and or a mechanism for notifications. What is going to be the unworked hours? What will happen with regards to sick pay? And what happens with regard to holiday? Will it accrue? And can employees take leave? Also, there are other areas to address. We know the large corporate financial assessment test is a challenge, but it's really important to make sure that there is clarity that pay, the claim, and the short-time working agreement are all aligned, or we'll have some of the problems we found with the job retention scheme corrections. Flexibility will be needed, and HMRC has said they may well want to see the short-time working agreement. So if I just turn now to a quick comment on the job support scheme extension effectively. Here, this is primarily for businesses that are required to close because they're likely in a Tier 3 area. We only have a press release about this, so this is prepared from press release. We don't have the detail of the scheme. We expect this is for eligible employees who have been instructed to cease work because the employer has been legally required to close their premises. And therefore, employers will only be able to use the scheme for employees who cannot work, paid or unpaid, for that employer. The grant levels here are different. The grant level is 2/3, 67% of normal pay, but up to a limit of $2,100 per month. Again, doesn't cover national insurance or pension, and the claim timings are the same. Just finally finishing off on a couple of points, I wanted first of all to mention the combination of grant support. How can you combine these grant supports? Must you do so? You have to only claim the job retention bonus if you've already legitimately claimed under the job retention scheme. You can use both the job retention bonus and the job support scheme at the same time. And you don't have to have used the job retention scheme to use the job support scheme. And just finally, I just wanted to mention to you, because this is all connected with your strategic decision making, in terms of redundancy costs, there is some support under the job retention scheme for redundancy costs in some areas, not in others, but you do not get support from the job retention bonus or the job support scheme for your redundancy costs. So I'd now like to hand over to Jo, who's going to talk about the international aspects of home working and the coronavirus impact.
Thanks, Carolyn. So yes, as Carolyn mentioned, in this section I'll cover UK and global home and remote working and how this has changed since coronavirus. So by way of introduction, obviously home working is not a new concept, but it's probably fair to say that in most organisations full-time home working was not the most common employee arrangement. Of course, that changed pretty much overnight when the UK and other countries on a global basis went into lockdown as a result of coronavirus, and organisations, of course, depending on what they do, in some cases had an entire workforce moving to home working. I don't need to tell this audience, I'm sure that there are so many considerations there, things such as health and safety, IT equipment, connectivity, etc. But what we wanted to mention today is that there are both employment tax and employment law implications of such arrangements. These do differ depending on whether these are as a result, so they're temporary and as a result of coronavirus, or if this is a permanent change to work location and work arrangements. And of course, one may well lead to the other, as we are seeing more and more. The other thing, sorry, Steve, if you could just quickly go back to the prior slide. One thing that we did want to sort of really draw out is that ideally and critically, employers should have a documented policy around home working. We're certainly seeing a lot of activity around putting these in place or updating them. And this should factor in overseas because those implications are so much more complicated, which we'll come on to a bit later on. So just covering a couple of HMRC concessions and exemptions. So of course, this is specific to UK home working arrangements. So HMRC have announced that there is an exemption for coronavirus test kits, which are provided by the employer. Again, an exemption for PPE provided or cost reimbursed to employees. There's an exemption for home office equipment, which is bought by an employee to enable him to work from home, and this cost is reimbursed by the employer, of course, provided there is no significant private use. And finally, as always was the case, there is the £6 per week home working allowance, where HMRC have confirmed that this is also applicable to home working arrangements which are as a result of coronavirus. So moving on to global remote working and work anywhere. This will be the focus of the rest of the session, primarily because we've seen a significant increase in this. It's more difficult to monitor than domestic home working, and it does bring with it additional complexity and cost. It doesn't necessarily affect companies who are already operating on a global basis. So, for example, a UK business who has just one UK employee who is working overseas on a global remote working arrangement, some of these considerations might well apply. So just by way of background, at the start of the pandemic, we saw a few things. We saw employees who were displaced due to coronavirus lockdowns and quarantines on a global basis. So, for example, employees who were overseas on business trips actually getting stuck in locations on a global basis as those lockdowns happened and quarantine arrangements came in. We also saw employees who relocated due to lockdowns, but this was more for personal reasons. So they wanted to get back to their home country or family. So, for example, one UK headquartered business we spoke to early on had around 30 UK employees who happened to be from outside of the UK and went back home pre-lockdown. And as the pandemic has progressed, we've seen, obviously, employees working outside of offices for months. This looks like it's likely to continue, and a lot of businesses are seeing more and more requests to work from different locations, and this can often be overseas. Encouraged, of course, by some press articles talking about working in Barbados for a year. We also see the onboarding of new employees. So as a positive of all of this, the global talent pool has opened up, and we see global remote onboarding of new employees. And of course, that increased flexibility is now a new necessity and is expected by employees on a go-forward basis. So moving on, what are the issues really to consider for global remote working and work anywhere? So where an employee works in an overseas location that is different to that of their home employment contract, it can potentially create a number of issues, both for the employing company and for that individual concerned. It is important to note that this excludes arrangements which have specifically been put in place to manage these risks, such as a formal expat assignment arrangement. So as you can see from the diagram there are quite a number of varied considerations. So I just wanted to draw out a few of the key ones that we see on this issue. So the first is the corporate issues and permanent establishment. So this is where an individual carries out duties in another country that may create a corporate presence in that other location for the home employing company. As a rule of thumb, a lot of businesses will put out a communication to say, don't carry out activities such as concluding contracts or sales activities. It's important to note that this applies even if the company has an entity already in that other jurisdiction. So if we take an example of an individual who is on a UK employment contract working out in the US, that individual may create a corporate presence or a PE for the UK company in the US. And what that brings with it is potentially exposure to US corporation tax and also a lot of administration around the various registrations required. Moving on to employment tax and payroll considerations, which are sometimes but not always linked to permanent establishment. So there can be obligations to operate payroll very, very early on. We see this a lot in Scandinavian countries. Also other linked employer obligations, for example, superannuation in Australia, which as we've observed during this period, does apply even without a PE. Social security, which is in point both for the employee and the employer. So usually this is due where work is performed, but there are a network of agreements both intra-EU and on a global basis, which means it is possible to stay in your home country for social security purposes, but an application must be made and monitored. This is an important area because social security rates can vary quite considerably around the world. In France, for example, it's around 45%. And from an individual perspective, that individual may trigger individual tax residency with personal registrations and personal filings that are needed. And if that individual is there working for a company, they might argue that any difference in tax might be met by the company. So that's something that needs to be considered. And I won't go into detail on the others, but it's fair to say that there are policy, transfer pricing, and legal and immigration considerations around these sorts of arrangements. But a key point is that there's no one answer. There's a different consideration for each individual's set of facts and circumstances, the two countries involved, and the corporate profile. So moving on. So what have we actually seen? So it has actually varied depending on an organisation's processes and their experience of dealing with global workforce issues. And of course, initially, when lockdowns were happening, the response was just to allow individuals to do what was needed. As it became clear that the pandemic was progressing and it was going to be going on for a little bit longer than we all would have liked, many countries announced limited relaxations for things like permanent establishment, individual taxation and residency. But these were limited both in terms of duration and also application. So often they would only apply, for example, if an individual was stuck because of coronavirus and not because they'd chosen to go back to that country. And we saw organisations who became aware of this issue adopting their own thresholds for practical purposes to manage this risk. Some taking an approach of as low as 30 days, so not allowing individuals to work anywhere overseas for 30 days, but many using the 183 days, which comes from the network of global double tax agreements, which allow for periods of temporary working to be exempt from tax subject to certain conditions. Although it's important to note that if those 183 days are exceeded, tax is due from day one. So finally, what are the issues that organisations have faced with this? So I think the first one really has been around tracking. So understanding who are these individuals and where are they? Often if this was for personal reasons, that individual would have made their own travel booking, so it wouldn't have gone through a corporate or a company travel booking arrangement. Even for businesses with a global mobility function, I think initially this wasn't really seen as global mobility, so it wasn't really covered by this in terms of process. So often a change of working request, for example, would go to a line manager or someone in the HR department. And that leads on to the next point, which is process. Processes were not really set up for this particular way of working and the volume in which we've seen this increase. So again, if a change of working arrangement was put forward, it wouldn't necessarily capture that this was an overseas location or an overseas address. And finally, communication. Trying to get relevant stakeholders in the business, both on a UK and a global basis, to understand this issue. So what now, and what actions have organisations been taking? So the first is risk reviews. So looking at the existing global remote workforce to understand compliance obligations and risk exposure, particularly as we're seeing now that 183 days has been exceeded if we think people might have been working since March somewhere outside of their home employment contract country. These reviews have either been done on an entire workforce basis, but actually more often what we're seeing is this is focused either on specific jurisdictions which are perceived to be more risky, or for certain sorts of individuals, potentially senior executives or sales force, who are more likely to consider to trigger things like PE. And if those arrangements are continuing to look at ways of managing that, so for example, if there is a local entity in that jurisdiction, actually offering that individual a local contract, so local terms, conditions and local payroll to manage that risk. And finally, on a go-forwards basis, what we're seeing is organisations needing to decide on what their strategy is. What is their strategy for allowing this work anywhere on a global basis? Is it not allowed at all on an exception-only basis, or certain parts of the employee workforce? Documenting that in a written policy and ensuring that the internal processes are in place to ensure that the appropriate people are signing that off, to make sure that the arrangements are best put in place to manage this from a tax risk and cost perspective. So that's a bit of a high-level overview of the key considerations, and I think it's fair to say that there is a lot to think about with work anywhere arrangements, particularly when they're on a global basis. And with that, I'd like to hand back to Carolyn, who's going to give us an employment legal update.
Thanks, Jo. As Jo said, I'm going to give an employment legal update, but I'm also going to focus initially on holiday pay. So if we look at holiday pay during and after the receipt of job retention scheme grant claims, and what we have so far as guidance. So we've had guidance from ACAS, which says that workers must receive their usual holiday pay in full during a period of use of the job retention scheme. And then in terms of guidance that we've had from HMRC, they've said that holiday taken during furlough should be paid in accordance with the working time regulations. So what does that mean in practice? We look first of all at some of the headlines in relation to the calculation of holiday pay and debunk some of the complications. First of all, the working time regulations, which apply in the UK, provide for 5.6 weeks leave. That includes working time directive leave. I'll mention that in a moment. It's based on the calculation of a week's pay, which is a term of art. And just to mention, we have 8 bank holidays in the UK, so that 5.6 weeks includes that period as well. The working time directive requirement is 4 weeks. That's the EU requirement. It is subsumed within the 5.6 weeks. And generally, and this can be relevant to working out calculations as well, the first 4 weeks of annual leave taken in any holiday year is generally assumed to be working time directive leave. So I'm raising this now because there's been a change. The changes to the reference period. And rather unhelpfully, if you've got a calendar holiday year, then the position is that the period up to the 5th of April 2020, the reference period was 12 weeks, but from the 6th of April 2020, the reference period has changed to 52 weeks. So in terms of assessing the weeks which we are counting over the reference period, we've got to look at whether furlough weeks count, and does furlough pay during those furlough weeks count for the purposes of the reference period. In terms of pay, under the working time regulations, it's a week's pay, and the week's pay is average remuneration. But under the working time directive, it's normal remuneration for working weeks. And basically, the working time directive normal remuneration has additional pay elements to those which are included within the average remuneration for the working time regulations. So if we turn now to some specific categories here to look at how we would work this through. First of all, employees or workers with normal working hours where remuneration doesn't vary with the amount done, which we now recognise as fixed rate employees, which we've got the concept we've been used to under the job retention scheme. There you look at basic pay payable for the normal working hours, so that's the week's pay, but with the reminder that there are required to be additional variable elements added when we are looking at the working time directive elements of the leave. So the question is, have we had a change to basic pay, or has it actually been a temporary change? So in terms of furlough pay, where furlough has been on reduced pay, more likely it's a temporary change, and therefore more likely one would be looking at the normal basic pay, or the normal elements to be included in working time directive, normal remuneration. And secondly, on the right-hand side here, if we look at those different category with normal working hours and where remuneration does vary with the amount of work done, firstly, or where remuneration does vary with the hours varies effectively. The first category, you're looking at the sum of remuneration earned in the reference period divided by the total hours worked and multiplied by a normal week's hours. And secondly, you're looking at the sum of remuneration payable in the reference period divided by the total hours worked and multiplied by an average week's hours. So the average remuneration is for working weeks, and whole weeks of absence are not counted, so whole weeks of furlough are not taken into account here. And then if we look at the third category, and this is the one where we do get some issues, so if we can just move on, this is where we have employees or workers with no normal working hours. So in terms of the working time regulations, the week's pay is the average weekly remuneration based on all remuneration payable in the past 52 weeks in which remuneration was payable. So here, non-working weeks are taken into account, but not weeks where no remuneration was earned. So the critical question here in relation to furlough pay is whether furlough pay is remuneration. If it is, then it's taken into account. And the point I just wanted to flag here is that we don't have, in relation to the calculation of a week's pay for holiday pay purposes, any statutory disregard required for a furlough pay reduction. There is a contrast here because government changed the law on the 31st of July to indicate that a furlough pay reduction is not to be taken into account in calculating a week's pay for the purposes of termination payments. But they didn't change the law, as far as I'm aware, in relation to a week's pay for holiday pay. And then if we look at whether furlough pay is normal remuneration, if we're looking at those 4 weeks under the working time directive, then there, for the working time directive, remuneration has to be intrinsically linked to the performance of tasks that the worker is contractually obliged to perform. But on furlough, we have a situation where the employee is not performing any tasks. So is it the case that their furlough pay is not taken into account? Or does the employee retain the performance obligation? Is it perhaps suspended by agreement, by the furlough agreement, and therefore furlough pay would be taken into account? And clearly this is relevant where furlough pay is reduced. It's not clear, so I just wanted to flag those challenges and to say beware. But let's move on just to a couple of final points. What's happened in the past 6 months that perhaps you might not have heard of? First, changes to employment contract requirements came in from the 6th of April. And this is for employment particulars issued, now required to be issued on or before the start of employment for all new employees and new workers. That's a change. So it's on day one, new employees, new workers. We've got additional categories of particulars required. We have to now make sure we state the probation period, the length and the conditionality of it, whether hours and days of work are variable, terms and conditions relating to paid leave in addition to holiday and sick pay, and particulars of all benefits provided by the employer, and for training to specify what training entitlement is provided, what training the employer requires the worker to complete, and other training that has to be completed which the employer doesn't pay for. So an action point here is to prepare separate contracts for employees and workers, to make sure you insert benefits such as bonus, commission, private health in the contract, to update those handbook policies for the other paid leave, and to write a training policy. And as well as for new employees, just a link to the job support scheme changes here, because when terms change, there may well be a need to comply with these new regulations. And also employees can ask for an updated contract. They might do so as part of the short time working agreement change. And just finally, looking at what may be on the horizon, what may change, we are expecting an employment bill at some point during 2020. So turning then to the potential for what would be included within the employment bill, this may be new rights for workers with 26 weeks service to request a more predictable and stable contract in terms of days and hours worked. You might have more of these on your books since job retention schemes, so you might want to bear that in mind. It was proposed to bring in compensation for shift cancellation or curtailment without reasonable notice, and a right to flexible working for all to be a default from day one unless employers had good reason. This, of course, connects with home working, which Joe mentioned, or moving staff to a virtual workplace. We were also expected to hear more about a single labour market enforcement body for national minimum wage, holiday pay, sick pay, very much connected, I think, to the HMRC audit of job retention scheme and some of the methodology they would use. And just a couple of further points in relation to cases. The Uber case on working status has been heard by the Supreme Court. We're awaiting a decision on whether Uber drivers are workers and what periods of working time. And just a tip in relation to connections with the job support scheme. When making workforce structure changes, don't forget there's always the claims risk. Discrimination rights continue. Be careful when you're selecting people for entitlement under the new schemes or for redundancies. So I'm now going to hand over to Lee, who will cover the off-payroll working reforms from the 6th of April 2021.
Thank you, Carolyn. So I'm going to be talking to you today about, as Carolyn mentioned, the off-payroll working rules, commonly known as IR35, and the changes to those rules from April next year. Just moving on to the next slide. Hopefully you have all heard of IR35 before. I know that we've covered it on employment matters events in the past. Something I'd just like to clarify at the outset is that IR35 only applies where a worker is personally providing their services through their own intermediary, which normally means their own personal service company. It doesn't apply, IR35 doesn't apply, where an off-payroll worker is engaged directly as an individual without an intermediary being involved. In that situation, the hirer must always consider the individual status to check whether they are generally self-employed or employed for tax purposes, and then to apply PAYE if they look like an employee. So I just wanted to make that clear at the outset, because what I'm finding is there is a bit of confusion about that. So back on to IR35, the rules have been around for a long time, but on the 6th of April 2017, they were significantly changed for the public sector. Now, up until that point, IR35 had always been the obligation of the worker themselves to consider and to apply if the rules applied. But on the 6th of April 17, when the public sector rules changed, the public sector hirer, or the end user, became responsible for considering IR35 and the worker status. And if they looked like an employee, IR35 applied. The fee payer, which might be the end user themselves or someone else, was required to apply PAYE when paying the worker's intermediary. So that means deducting tax, deducting employees class 1 NIC, and paying employers class 1 NIC as well, along with the apprenticeship levy. Now, it was the intention of the government to extend those public sector rules to the private sector too, but with some changes from the 6th of April 2020. That was delayed by the coronavirus for a year to the 6th of April 2021. We now have the final legislation for the private sector, or for the new off-payroll working rules applying from 6th of April 21, and those rules are going ahead from that date. So moving on. So the changes from the 6th of April 2021. All public authorities, all public sector end users and medium and large size private sector end users will be responsible for deciding the employment status of workers providing their services through their own intermediary from that date. But they have to be the end user of the worker's services to be required to do that. Now, for private sector organisations and businesses, small private sector end users are excepted from this. They don't have to consider these new off-payroll working rules from April 2021. The existing rules will continue to apply for those small private sector end users. So the worker themselves will need to consider IR35 and to apply it if it does apply. The rules apply to all public sector end users and to private sector end users that meet two or more of the following conditions. So these are the threshold tests for private sector end users to determine whether they're medium or large, i.e. not small. So two or more of these conditions have to be met: an annual turnover of more than £10.2 million, balance sheet total of more than 5.1 million, or more than 50 employees. Now, that's very much an overview. Those rules can be quite complex in certain situations. For example, where a private sector company is part of a group, the group size is determined by its parent company size. And in order to identify the size of the parent company, the figures from all the members of the group have to be aggregated. And the outcome then applies to all the members of the group. There's also some special rules for particular circumstances, such as identifying when you exceed these size tests for the first time. There's special rules for joint ventures, for new corporate entities, and for non-corporate private sector end users as well. Moving on. So public sector end users and medium and large private sector end users using workers who provide their services through their own intermediary will need to apply the following approach from the 6th of April 21 and in preparing for the 6th of April, in preparing for that date as well. Now, this is the case even where an agency or similar is involved in the labour supply chain. So step one is to determine whether the off-payroll working rules might apply. So there is an exception where the end user is receiving a fully outsourced service. IR35 doesn't need to be applied in that sort of situation. What we're talking about there is a fully outsourced service and not just the provision of labour. So an example might be where a company enters into a contract with a building maintenance company, and under that contract, the maintenance service provider provides a range of services, but the workers remain under the control of the maintenance service provider. In that situation, that might actually be a fully outsourced service outside the scope of the IR35 rules, but each case needs to be considered based on its own facts. Once that's been determined, if you are into IR35 because you have the provision of labour, you have to consider the profile of the contractor entity. You have to consider something called the conditions of liability. Those are essentially to determine whether the worker that's undertaking the work controls the entity they're providing the services through. If they do, you are into IR35 and you're looking at step 3. Step 3 then requires a status check to be undertaken and a status determination statement to be issued. The status check is looking at all those rules around status, such as right of substitution, how much control is being exercised, mutuality of obligation, how much financial risk the worker has in the relationship. And then if they look like an employee, then tax and NIC has to be deducted by someone in the chain. That might be the end user, that might be the fee payer if different. There is then a process for appeals that has to be dealt with, but we'll get to that later on in the presentation. So moving on, a status determination statement. From the 6th of April 21, the organisation responsible for determining the status has to issue a status determination statement. That then has to be communicated to the worker themselves and to another party in the chain that the end user contracts with if the worker is provided through a longer supply chain, for example, or via an agency. So once the organisation has issued the status determination statement to both the worker and the person they contract with, and reasonable care has been taken when coming to the conclusion, then the client has really satisfied its duties under those rules. The CES test can be used as part of the status determination statement. It may need a bit of tweaking and adapting, but the HMRC CES test and the output of that can actually be used as part of this. So moving on. So this slide shows how the status determination statement must be passed down a labour supply chain. So what you can see on here is the client on the left-hand side having to pass the status determination statement to the worker. In this case, because it's provided through a longer labour supply chain, which is involving 3 agencies, including the fee payer, the client has to pass it to agency 1 as well, who then pass it down to agency 2, who pass it to agency 3, who are the fee payer. That's essentially how the statement must pass down the labour supply chain in those circumstances. Now, there are recovery of debt provisions or transfer of liability provisions. Where there's non-compliance down the labour supply chain, what these rules allow HMRC to do is to recover the debt from the agency at the top of the chain or from the client if they can't recover it from the party who's actually failed to meet their obligations. So in this example, agency 3 is required to give the status determination statement to the fee payer, but they don't do that. They fail in their obligations. But HMRC can't recover the liability from agency 3 for a particular reason. So under these transfer of liability rules, they can actually go after agency 1 in the chain for the debt. They can recover it from them. If they can't get it from agency 1, then they can actually go after the end client as well on the left-hand side. So these are rules that you need to take particular care of. I mentioned there's a disagreement process. So once a status determination statement is issued to a worker, it's possible that they might challenge it. You know, if an end user determines that they look like an employee, they might disagree with that. They are able to challenge that and appeal it. And if they do, then the end user must respond within 45 calendar days of receiving that. They must inform the worker of the outcome, and if the outcome changes, they have to issue a new status determination statement as well, if that original conclusion was found to be wrong. Now, failure to respond to that can lead to the end user being held liable for the tax and NIC due. So again, something to be very much conscious of. There's also a duty to confirm side. So if a worker requests that information from a hirer, then they are required to provide it within 45 days. And if they don't, then they can, or the worker or the requester can apply to the courts for an injunction to enforce that. Again, another thing to be careful about. Some practical considerations on the slides there. I'll just whisk through those quickly. There's really a need to understand your responsibilities from the 6th of April 21, understand your off-payroll workforce. There's quite a lot of work that might be needed to review it, to make sure that you start looking at that as soon as possible. Engage with internal and external stakeholders. You know, form a team really to look at this, a little task force, and agree updated processes and procedures and controls as soon as possible. Certainly in advance of 6th of April 21, and don't forget about the need to do an ongoing review after 5th of April 21. You know, for engagements that carry on after that date in the longer term, you'll have to review them on an ongoing basis, and for all new engagements, you'll need to review them to be compliant with the rules as well. So that's very much a whistle-stop tour of IR35. I'm going to hand back to Steve now, and I think we're going to do a general update.
Thanks very much, Lee. So I mentioned at the beginning that the general payroll update will be, it certainly will be, Thankfully, at this time of year, with so much to do for payroll teams based on the topics we've already heard about, there isn't too much by way of mechanics or technical updates. Generally, if they are going to come, they'll sort of come at the beginning of the year prior to sort of April new tax year. But just a few things on there being pulled out of the latest HMRC bulletin. 1 and 3 there are related to HMRC's ability or the relevant body's ability to process things remotely themselves, and there's a delay in national insurance numbers being issued because paperwork can't be examined in the usual way. We're assured they are working on a digital solution. Penalties, again, they're having to take a risk-based approach to penalties rather than charging them automatically. Probably the one, and if you're not already aware of it, it's mainly going to relate to if you are having employees up in Scotland, the student and post-grad loans, so number 5 on the slide there, from next April there will be a plan 4 introduced which will relate to Scottish loans, and all of the thresholds will go up. And it wouldn't be an update from me if I wasn't just reminding everybody during these times when our focus is kind of dragged in other directions to make sure that we stay on top of our workplace pensions responsibilities, because there will be re-enrolment dates that are kind of creeping up on us, that kind of our other focuses might mean that they sort of get put on the back burner. So moving on to some questions. Again, I'm conscious of everybody's time, and we will finish on time. And after the questions, I will be passing or giving you all the contact details for all of today's speakers. So if we don't get around to your specific question, apologies, but you will get the email address to sort of follow up with us directly. So I think we're going to have a go at inviting everybody into our own homes. So if the speakers all want to put themselves and start their videos up so that we can sort of see the whites of our eyes. I'll try to group the questions together, as many as I can, in terms of best use of the last few minutes to get as many of these covered as we can. And then, as I say, I'll pass you contact details around afterwards. So Lee, I know that you've only just gone on mute, but back to you. A couple around the sort of the tax credit, the working from home tax credit. One around, can it be backdated? So if people haven't used it yet, can they go back? And the other one around, how does it work if maybe they're working 3 or 4 days a week from home and 2 days from an office? Can it be partly?
Yeah, no, that's fine. So backdating, yeah, that's possible, provided that employees have been working from home because of the coronavirus. So backdating back to the beginning of the tax year, I'm assuming that's what the question is about. That's absolutely fine. You obviously want to make it clear what the payment is for. There's no need to prorate for part-time workers who are required to work from home because of the coronavirus. There's no need to prorate where people are splitting their time between the office and home because the office has remained open, provided that they are required to work from home because of the coronavirus. This is a relaxation of the rules because of the coronavirus. Under normal arrangements, it doesn't work that way. So it's something to keep an eye on. That might change.
Thanks, Lee. And there's a few for you, Carolyn, and I'll kind of give you a caveat right at the beginning that some of these relate to the JSS. So apologies on the basis that, as you've explained, we don't have the detail as yet. But just your thoughts on a couple. One relates to resignations and a redundancy consultation process. So, i.e., when from the 1st of November, if someone resigns, do you think we'll still be able to apply under the job support scheme? And also, if maybe intentions are there's no redundancy, but say in January, having claimed in November and December, is there any reason why we shouldn't enter in those employees into a sort of consultation process if their circumstances change?
As you say, Steve, we don't have the details of the scheme yet. What we understand is that you cannot claim for people who you have given notice of redundancy to. So you will not have given notice of redundancy at a time that you're consulting with them. If they have given you notice, I don't know yet. It was a bit of a surprise when we got the job retention bonus content to see that actually if employees gave notice, that couldn't be claimed. We thought it was only if employers gave notice. I'm sorry we've got to wait for the detail of the scheme for those questions.
No, that's as I expected. One that relates to the job retention bonus, it's come up a couple of times today, so I will ask it. Is there any kind of limit to how recently an employee had to have been furloughed? So if they were off, for example, for a month in April, but they've been working since, so they were furloughed in April but haven't been for the last 4 or 5 months, could they still claim the job retention bonus, or do they have to have been furloughed or on a furlough period more recently?
No, as we understand it, they just have to have been legitimately furloughed. So if it was only a 3-week period in May, then that will qualify.
Excellent, thank you, and that should be useful to a couple of them. So I can see the clock is ticking. I'm just going to ask one of yourself, Joe, a kind of a wide-ranging one. And are there any particular countries that you'd see as being key to consider for global remote working risk?
Yeah, that's a tricky one, Steve. But I guess what I would, we talked earlier about the facts and circumstances of each individual case being, critical. But I suppose in terms of particular jurisdictions, I've already mentioned the Scandinavian countries. And the other one I'd mention is the US, because of course there's the federal sort of national tax to consider, but also each individual state has very much its own rules and regulations, and that can be quite difficult to monitor, track, and adhere to.
Yeah, thank you. I think that is all we're going to have time for questions. I'm going to whiz through the slides. What I'll say to everyone attending today is these next few slides will be useful reference points to you to kind of understand. I said at the beginning I'm going to talk to you about how RSM can help. So there are a number of slides that are going to take you through the sorts of things we can do. We'll be circulating these so that you'll all have them available to recap on what we have spoken about, as well as a recording of the event. But the slides that will follow the one, I'm leaving it up intentionally at the moment for the contact details, because I promise you I would. If we haven't got round to your question, please do reach out to us directly. As I say, the next few slides will just focus on how we as a people advisory team can help you. All the links, as when these are circulated to previous events, will be there for you to direct you to where you can find those. I would recommend, as I always do on these events, if you could visit our preference centre and make sure that we are up to date with what topics you would like to hear from us for, so that we can keep in contact with you. Other than that, all I need to do is thank you all for joining us, to all of our speakers. We have got a next event penciled in for the 10th of December. I can't promise that we won't be putting on another event, and as soon as we get some more details around the JSS and the JSSE, as I'm sure many of you will want to hear, but obviously you can sort of vote with your feet there in terms of joining us. So all that remains to be said is best wishes to you all from the RSM People Advisory Services team, and stay safe.